Well, good morning. Joginder Rana here. So the topic of the day is financial ratios for insurance companies. Financial ratios for insurance companies. Financial ratios are used to make a holistic assessment of financial performance of the entity. They also help evaluating the entity's performance vis-a-vis its peers within the industry. So financial ratios are not an end by themselves, but a means to understand the fundamentals of an entity. A standard set of ratios for evaluating the insurance companies are used. This can be divided into three categories, that is earning, liquidity, and solvency. So as far as the growth ratios are concerned, profitable operations are necessary for insurance companies to operate as a growing concern. Measurement of earnings focuses on an insurer's ability to efficiently translate its strategies and competitive strengths into growth opportunities and sustainable profit margins. Thus, the awareness of the importance of insurance is growing rapidly, and insurance companies are introducing new plans to the market, meeting the requirement of people of all ages and professions. It is important to identify the important factors which influence over decision making. It may be seen that all insurance companies offer similar policies with little to no difference in premium and coverage, and it conflicts with the customers regarding which insurer to pick. So there are various ratios on which insurance companies can be compared and can help the customers to make an informed decision. These parameters can help to assess an insurer's profitability, efficiency, and overall financial stability. So let us see some financial ratios that are important to an insurance company. First of all, there is the persistency ratio. As the name suggests, the persistency ratio indicates how many policyholders persist in a given period, usually 1 year. So it is the ratio of active policies and the total number of policyholders. If an insurer does not meet customers' expectations regarding claim settlement, customer support, post-sale service, etc., policyholders will eventually stop paying premiums. Hence, this ratio determines the customer satisfaction from an insurance company. The higher the persistency ratio, the higher the customer satisfaction. The formula to calculate this ratio is persistency ratio is equal to number of policyholders paying premium upon net active policyholders into 100. So favorable range is 85% to 100% and unfavorable range is less than 85%. This is called persistency ratio. Next one is solvency ratio. The solvency ratio determines the financial stability of an insurance company. The Insurance Regulatory and Development Authority of India, that is IRDAI, has made it mandatory for all insurance companies to maintain a 150% solvency ratio to ensure that an insurer fulfills its obligations to provide claims to policyholders in case the company goes bankrupt. So in simple terms, it is fair to say that the solvency ratio determines if the company has enough funds to settle claims in the most extreme cases as well. Or the higher the solvency ratio, the lower the risk of the company not being able to provide a claim. Formula for solvency ratio is net income plus depreciation upon liabilities. The favorable range is above 1 and unfavorable range is below 1. Then comes combined ratio. The combined ratio is used to define the profitability of an insurance company in terms of its operation and businesses. The combined ratio also indicates how effectively a business makes use of its resources. If the combined ratio is less than 100%, it implies that the company is making profit by getting more premiums than paying claims and other expenses. And if the combined ratio is more than 100%, it means that the company is in loss by paying more claims and expenses than collecting premiums. The combined ratio depends on various factors like agents' commission, staff salaries, and various other operational expenses. Formula to calculate the combined ratio is equal to expense ratio plus underwriting loss ratio, where expense ratio is equal to underwriting expenses upon net premiums earned, and favorable range is below 100%, unfavorable range is 100%. This is combined ratio. Fourth one is incurred claim ratio. The incurred claim ratio is the ratio of the net claim settled and the net premium allocated. It reflects the financial situation of an insurer. The IRDAI has made it mandatory for general and health insurers to publish their ICR in the annual report. A low ICR means the insurer is in a strong position as it is collecting more premiums than paying claims, whereas an ICR of 100% means the company is at risk as the premiums getting collected are exactly the same as claims being paid. The formula for incurred claim ratio is net claim settled upon net premium collected. Favorable range is 50% to 100%. Unfavorable range is below 50% and above 100%. And then there is a claim settlement ratio. The claim settlement ratio determines the relationship between claims filed and claims approved in a given time period, usually a year. It indicates the claim settlement efficiency of an insurance company. The higher claim settlement ratio ensures a policyholder's trust in the company. The higher the claim settlement ratio, higher the chances of getting a smooth hassle-free settlement. The formula for working out the claim settlement ratio is total number of claims settled in a year upon total number of claims received in a year into 100. Favorable range is 85% to 100%. Unfavorable range is less than 85%. Next one is commission expense ratio. The commission expense ratio defines the commission paid from the retained premium during a particular period. We must check the commission expenses ratio as it influences the premium paid by the policyholder. A low commission ratio is in favor of policyholder, as the lower the commission ratio, the higher is the discount offered, which leads to a lower premium. So the commission expense ratio is equal to total expenses upon average value of the portfolio. Favorable range is below 20%. Unfavorable range is above 20%. So apart from basic parameters like premiums and coverage, there are various other factors that should be considered before purchasing a policy. Above were 6 key ratios which determines the financial stability, the customer satisfaction and profitability. The insurance companies can be compared to each other on the basis of these ratios, which enables customers to make a much more informed decisions. So these ratios are used to evaluate an insurance company's performance, business and finances. You can determine a company's customer satisfaction, claim settlement, and financial stability by analyzing these ratios. It enables customers to make a well-informed decision. Customers can use these ratios when they are confused on which insurers to pick. One might be getting a very similar policy from different insurers, and these ratios will help in clearing the dilemma. So these ratios are generally calculated annually, but some of them are also calculated quarterly. Some of these ratios are published in annual reports as well. Customers should prioritize claim settlement and customer satisfaction by looking at these ratios. There are a number of ratios, say for example, premium growth, risk retention, loss ratio, expense ratio. They all have their determined formulas. Say for example, risk retention. That is worked out as net premium written upon gross premium written. This indicates the level of risk retained by the insurer vis-a-vis that ceded to reinsurers. Reinsurers plays an essential role in the risk spreading process. Loss ratio means net claim incurred upon net premium earned into 100. The ratio measures the company's loss experience as a proportion of premium income earned during the year. The loss ratio is a reflection of the nature of risk underwritten and the adequacy or inadequacy of pricing of risk. Then expense ratio. Management expenses plus or minus net commission paid or earned upon net premium earned into 100. The expense ratio reflects the efficiency of the insurance operations. Expense ratio for an insurer is analyzed by class of business along with the trend of the same. Investment yield, total investment income upon average total investment. So this ratio measures the average return on the company's invested assets before and after capital gains and losses. So while calculating the investment yield, including capital gains, both realized as well as unrealized capital gains are considered. Return on net worth, profit after tax upon average net worth. This ratio reflects the post-tax return generated on net worth of the insurer. It's a measure of overall return of the equity deployed in the business. Similarly, there are certain liquidity ratios. These are known as the liquidity assets to technical reserves, liquidity assets to current liabilities, and then there are solvency ratios. So solvency means adequacy of solvency margins forms the basic foundation for meeting policyholders' obligations. So all insurance companies are required to comply with solvency margin requirement of the regulator as prescribed from time to time. Currently, the Insurance Regulatory and Development Authority of India has prescribed statutory minimum of 1.5 times solvency margin for insurance companies in India. So solvency margin for insurance companies is akin to capital adequacy ratio of banks. So solvency ratio is available solvency margin upon required solvency margin. Compliance with minimum requirement of 1.5 times as well as cushion available above the regulatory minimum is examined. Then operating leverage means net premium written upon net worth. This ratio indicates current as well as potential underwriting capacity of an insurer. And this liquidity assets to technical reserve is worked out by liquidity assets upon current liabilities. That means technical reserves are reserves created to take care of expected claims that may arise. So while an insurer may not be expected to maintain liquid assets equal to technical reserves, a higher proportion of liquid assets would help the insurer in taking care of these expected claims. and the liquid assets to current liabilities is worked out by liquid assets upon current liabilities. That means the ratio indicates an insurer's liability to settle its current liabilities without prematurely selling long-term investment or to borrow money. If this ratio is less than 1, then the insurer's liquidity becomes sensitive to the cash flow from premium collection. Because good liquidity helps in an insurance company to meet policyholders' obligations promptly. An insurer's liquidity depends upon the degree to which it can satisfy its financial obligations by holding cash and investments that are sound, diversified, and liquid, or through operating cash flows. So a high degree of liquidity enables all insurers to meet the unexpected cash requirements without untimely sale of investments, which may result in substantial realized losses due to temporary market conditions and or tax consequences. So, profitable operations are necessary for insurance companies to operate as a going concern. Rating measurement of earning focuses on an insurer's ability to efficiently translate its strategic and competitive strengths into growth opportunities and sustainable profit margins. So these ratings analyzes the profitability of the underwriting and investment functions separately of an insurance company. Thank you. Thank you very much.